The following is a presentation of TFNN. The Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
Hi everyone, Basil Chapman, Tiger Technicians Hour. My pleasure to be here on the 16th day of December. And what do you think it is? Yep, it's the Fed Speak Day at 2 p.m. So given the history of the Fed, probably what we'd be looking at is if there is the rate increase, they will, I suspect they will try to ameliorate it with some kind of talk about at this particular time, and that there's no intention to raise until we see further expansion, something like that. And really, it doesn't matter what they do, what they say. It's how the market reacts over a period of a day or two. So let's just run the numbers, and I'll give the scenario that could possibly occur, why this is such an important period, market-wise, regardless of what the Fed does, and the levels to watch. And just trying to keep it as simple as possible. And when we're looking at the Dow, which is now up 30 after being up 160, at 17,555, and the S&P is up 5 after being up, it's at 2048, after being up much, much higher. What we're looking at is a situation where normally as we go into Fed speak, you will just get a contraction. If the market is down, it'll sort of creep up to about unchanged. Market's up, it'll creep to unchanged. So there's nothing here that's unusual. Let me just show you a chart of the E-mini. Where did it go? ESH16. Look, this is the E-mini. I drew this in. This one I didn't send out to subscribers. I did send out the 120, which was at a peak D. It actually went to an E, to 20, 52, 25, and then pulled back. This is the 10-minute. And there was a beautiful peak C1, C2, but it held this very long-term, 10-minute chart, right? Long-term is not that long. Horizontal line, came right back to it, and then routed again to a leg D, went to a peak D, and I really drew in an arch formation with a left side, right side price time match, which it hit exactly. And then I drew another one lower down, and that one is at about 2042. Then I drew another one at 2038. And in fact, it should come in by the inside wedge targets 1220. We've already hit 2038.75. So I'm suspecting that we are now, this is pretty much going to be the range I'm thinking for the shorter term, somewhere between, in the E-mini March contract, somewhere between 2041, 42, and maybe 20, we'll take that out, maybe 2037, 35. Just a kind of a narrow trading range. So now let's go back to our story. And there's your peak E with the left side, right side price time match. So never got to the high. This high right here on the at the close on the 10th of December, 20.5875 was the high, and today's high is 20.5225. So it hasn't quite gotten there. Pulling back. So this is what I think is really interesting. Let's go straight. Well, I'll run the numbers. Dow's up 33 at 17,558. S&P is up 5 at 2,049. Comp index is up 11 at 5,006. Gold contract is up 12. It was up quite a lot higher before. It's 1073. It's silver's up 40 cents. That's a nice move at 1417. Platinum's up 21 at 876. High grade copper's up at 207. But you've got crude oil down at 35.90. Bonds are down 23 seconds at 154, and the dollar is down 11 cents at 98.17. So now let's do this. Without getting too carried away, What I've done for subscribers, because I missed that entry point, I had it, and then I backed out. I keep promising myself, don't change, but it really looked like it could be very ugly if, in fact, we went down a little deeper than we did on Monday before that very sharp rally. So I wasn't sure where to put in the stop. That was the only thing. And I didn't want to have it too wide, because if it closed at the low and then gapped down the next day, you're really stuck. I just didn't need any risk like that. So we didn't take the trade, didn't even have the trade because I didn't put it on. My mistake, we should have put it on. That was with the 3 times along the Dow, and that was trying to get it on Monday. I just said, okay, the scenario was too complicated to type into that little section that I put for that particular buy. So we missed it. However, if we were in and there was a rally at this particular point, I would have to raise the stop, because look what you've done in the E-mini, that horrible day. There it is. On Friday, where the market went from 2058.75 down to 2035.75, 43 points. No, oops, sorry, 23 points. That's enough. 23 points. That is big. Wrong. I thought I was in the wrong one. It went from 2047.75 to 1996.25. I thought that was really weird. And that is a huge move, 50-point move. So, and then going even lower to 1983. So the move that we've had has gone beyond, above the high of Friday. And now we've come down. So now let me just tell you what I'm looking at. And I will give an update to subscribers at 2:30. I usually find over the years that updates are useless. All they do is that the next day you could get an even better entry point. Once in a while, it'll be a perfect entry point. I remember once we got a 2 times short the Dow. It was March, I think. One of the years, the year we had that 22% decline, and we picked it up exactly right. I would not have got it if it wasn't. But most other times, the next day I could have got a way better entrance. So I probably will not do anything regardless of where the market is. But we'll make it real simple. If at 2 o'clock a gyration starts, because remember, you've got to have some kind of time lapse, because the very first action isn't always the way that the market's going to be. Sometimes there'll be a big spike up, and then that happens to be a perfect short because it doesn't come back again. Sometimes there's a big gap down, and then all of a sudden you're looking at 20 minutes later, or when the Fed chairman, Yellen, actually has the conference, if there is some kind of discussion at 2:30. So, and there probably will be. So this is what I'm looking at, just to make it as simple as possible. Let's go to the volatility index. The VIX right now is at 1998. Just 3 days ago, it was at 2681. Let me type that in. 2681, 26.81. And this is what I'm looking at. If the volatility index at 230 to 245 is, instead of right now 1992, if it is trading in the 22-ish area, let me just, if I can find it, because I'd like to quote what I said this morning. I'd already worked it out quite nicely, so why double the effort? Let me just give it to you. This is my opening call overview right here. Let me put it in here. And what I'd said is this the one? Yes. VIX spiking and holding in the 24s. I'm even going to put it a little lower. I'm going to say in the 22 or higher area. Sets the stage for a rally failure with low lows. But if the VIX plummets to the 18s, remember right now it's at 1990. If it plummets to the 18s or lower, now it doesn't sound like very much. Wait, now on the upside I'm talking about, I've made it 22 or higher. 2 points. The fact that the VIX is rallying at 245 when the market should have settled down should tell me that the Dow is down 50 or more points, the S&P is down 6 or more points, and if the VIX starts to plummet and goes down to 18 or less and holds, there's a real good chance that the market will be up sharply. S&P and Dow will be up nicely. I would like it to be with the composite index. I'd like them all to be together. That would suggest to me that there's a real good chance, here we go, that now I can talk about something else. IND, that the Dow will try to get back to the high that was made this morning already of 17,690. And it's 100 points lower right now. It'll get back. It still has this dashed trend line to break out of. So I wouldn't be surprised that even if there is a rally, that you start to get a kind of a fumble, a kind of a little bit of an overbought situation that needs to resolve. And then you're going to have a look at 17,500 to 17,550. That's going to be key support. On the other side, if the market starts to slide and the Dow is all of a sudden underneath 17,470, especially if it's under the 200-period moving average of 17,400, and the XLF is also much, much lower, that's the financials, then what we're looking at is something very different. We're looking at a situation that says the anticipation of the rally, of the market responding positively is not there. And now you have to start looking at major support levels, both on the daily and the weekly. Suddenly the weekly kicks in as really important. Why? Because if the weekly takes out the low that was made of 17,138 this week, meaning from late this afternoon into Thursday into Friday, and closes towards the 17,000 level, that's going to suggest in the chart formation that the upside is very limited, even if there's a rotation that comes in and kicks in to hold the market in a sideways pattern for another week. So just to be clear, an immediate response, you can go through the dollar, bonds, anything you want. I'm looking at the volatility index. If the volatility index rallies very sharply and holds there as the market pulls back, that's just going to put a lot of upside limits to caps on almost all the stocks and indices that spiked up earlier this morning. Now, here's something else that I want to introduce. The dollar. As I'm looking at the dollar now at 98.25 in the index, the technicals and the daily are kind of, the stochastic's trying to turn up. It's at 19, it isn't above 20, but it has crossed positive. The MACD is attempting to turn up, but it's way between the red line and the green line, the slow moving average and the 9-period differential. The weekly chart is holding quite steadily, but the stochastic's now at 75%. The MACD is holding quite nicely. This is, let me move the 120-minute chart away. This is going to be very important because the dollar's had a spectacular move. It kind of deserves a sideways move, a sideways consolidation. After having made the cup formation, you can often expect, if there isn't an immediate breakout, which should have been last week, not this week, but last week, that says that there's probably a handle formation coming in here. That leads me to the dollar and the relationship to gold, and I'll be back in a moment to talk about that.
It's true. Life is all about choices. At Everbank, they're making it easy for you to make a smart one with this special cash offer. Open a new yield pledge money market account with funds from another financial institution, or deposit new funds into an existing yield pledge money market account, and you could earn up to a $500 cash reward. And if you're opening a new account, you'll also get their new higher 6-month bonus interest rate, along with their yield pledge promise that ensures your yield will always be in the top 5% of competitive accounts at banks nationwide. Open a new account or add to one. It's your choice. To qualify, you must meet balance and other limited time offer requirements. Go to everbank.com/TFNN for details and deposit options, or speak with one of their banking specialists at 1-855-750-4051 for more information. You must act by December 31st, 2015 to be eligible. Everbank is a member FDIC.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman wave sequence. Using the Chapman wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Basil takes your phone calls. Now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back. Dow's up 11. S&P's up 3. So let's continue with the thinking here, at least with my thinking. The dollar, if the dollar spikes, it's got a lot of work to do to get back to the 100.39 previous high. That was back in March of 2015. And the most recent high, I think, was 51. 51. And at 100.51, in my work, when you make a double top or a double bottom, and you do it just by a fraction, and then you close away from it, it says that you should be moving away from that level. And here we go. It's starting to pull back. So I'm suspecting that the dollar could, in fact, be in a trading range, a small trading range, maybe with slightly lower lows and lower highs if it doesn't rally today, because if it rallies today, it's got to get right into the 99.20 area. It's got to have a really nice spike to the upside and hold that spike. And that'll suggest, okay, it can move higher. But then wait a minute. What about gold? What about crude oil, which is, I mean, must be swimming in crude oil from the action in crude oil. But here's what I'm looking at. This is the first, and this is what I spoke about the opportunity. There was a question as to what was I seeing in oil, talking about a spike. What spike? I'm saying, are you kidding? Oil takes out in one session all the left side lows, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. It takes out 10 sessions with that spike that went from, in 2 days, it went from a low of 1, says gold. I meant oil. Let me go back to the USO. it takes out the USO. It took out 3 days worth of left side rallying with that pop-up, and that was what I was talking about. And what I said was that if there's going to be a pullback in the dollar, this will be the first time that crude oil has shown signs. And look, the MACD, let's move this across. You'll see USO's the United States Oil Fund LP. And what we're looking at, this is the first time that the on-balance volume has gone this low and made a V-shaped pattern, number one. Number two, the histogram in the MACD had just started on the day I was talking about it. It just started to show that it was narrowing a little bit between the 9-period differential and the red line. So that's the histogram. And that the stochastic was trying to turn up, and in fact, in some ways was just as good, just as low as it was when the price of crude oil was way higher in the 13s. Therefore, and this is what I was saying, if one was prepared to take the risk, and two people called and one said, I will take off one of my positions and I'll keep one, and we'll watch the low of the day, which is 1079. That was of the 14th. So this is the first time that there's just an opportunity for, if the dollar pulls back, for the commodities, including oil this time, and gold. Now look at gold. Gold is the one that had that spike to the upside and took out all those left side lows in two moves, really one. And then it gave back about 2/3, but a nice candle today. And that's suggesting to me, once again, I'm going to repeat, that in terms of risk reward, this could be the first time that if the dollar, the saying goes, if the rates go higher, the dollar should move higher. The chart of the dollar says maybe so, but it's going to have a tough time. It's going to have to be just triggered by some technical strength, because it's not showing the technical strength in the chart formation as it stands. So if the dollar starts to pull back, this will be the first time. That's what I'd said. And I still stay with that because the technicals have improved. Look at the way the stochastic in the gold index has been rallying, and then finally got a price move to the upside. And the MACD crossed positive. So it's not incredible strength, but it's the best strength it's had in quite a while. Best strength is the gold had that big move that took it from the 11th of November at 1097 all the way to the October the 15th high of 1191. That's what I'm saying. Okay. And I feel quite strongly about it because the way the dollar is acting, the way the euro, EUR, USD, has held very nicely with a very good sense of 84% stochastic, and MACD still strong. Euro-dollar currency pair trading at 1.09 above the 9-period moving average since it broke out. It's suggesting quite strongly that this is the opportunity. Remember, I'm talking about the opportunity for the commodities to have at least a decent rally while the dollar pulls back. What does it do to the market? We'll talk about that when we get back.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now, you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile-based scanner in the industry. Powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com. Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, we're back, and as I'm looking at the euro-dollar currency pair, I'm also looking at the USD CAD. We'll try to tie them together. Look, United States dollar, Canadian dollar has had a spectacular move. I mean, you've heard John Logan talking about this for a while. What it did is it broke out. Now, I've got alternate counts, but at this point, I still feel quite comfortable that this is leg B in the weekly chart. Leg D in the monthly chart. Look at the spectacular monthly chart. In this bowl formation, it's actually more like a lung formation because it's got the left side and the right side. And it's breaking out and it's trying to test the high of May of 2004 of 1.4002. And right now it's 1.3846. So it has a little way to go, but I think it could also have a little bit of a breather right here because the MACD is still very strong. Stochastics at 93%. So it doesn't have to break down, but it could have a little bit of a pullback. 1.36 is the major 9-period moving average support with 1.35 coming up next. So put that together with the euro dollar, and either the euro is going to tumble to the 1.08 level very quickly by this afternoon, or it's going to have another rally, and that rally is going to take it either to yesterday's high of 1.10588, or if it doesn't, it'll be peak B. But if it holds in this area here, that's going to be very positive. Not only that, in the methodology that I use of the H formation, this H formation in the euro-dollar currency pair, which did not break the left side low of May, I think it was. It was May 4706, yeah, 4617. So that was the week of May the 13th. It went down to where did it go? 4617, 04617. So this is an arch formation, still makes that C intact, not a C minus here, didn't take out the low. But if it has a spike here, it could very quickly go to the 1.149 high of the week of the 16th of October. So I'm looking at this and I'm going to say again, in terms of risk reward, the dollar's had a spectacular move. There's no problem if it has a little bit of a pullback here or sideways move, number one. Number two is there are signs of strength, little mini strength, which could be knocked out in a second. But if it holds, you've got the Euro USD, the euro dollar currency pair acting very well. You've got the potential for gold to have a really nice up 13 now, to have a really nice move to the upside. You have the potential for crude oil, even though it's not the best trade. I would rather be in the gold area right now than the crude oil. But if that has a spike and it takes out, it's at 35.71 on the continuous contract, instead of taking out the lower 3 days ago of 34.53, if there's a move that takes it, doesn't even have to close there, it just has to go above 37.88, and that's going to say immediately, hey, I'm in play. I'm in play to have formed some kind of a base that allows me to at least have a bounce. That's what I'm saying. Now, let's go to something else that I think is going to be quite critical. The XLF trading now lower than it was at the after the opening. It had a high of 24.35, trading right now 24.13, having almost touched the 9-period moving average support of 24.05. It went to 24.05. 24.04 is the 9-period moving average support. If there is a commensurate rise in the bank stocks and the financials and the whole area of the S&P Select Financial Spider Fund, which is a mix because it has Berkshire Hathaway, it has Wells Fargo, JP Morgan, Bank of America, Citibank, USB, AIG Insurance, Goldman Sachs. It's just all over the show. So insurance with MetLife, I believe it is, Prudential, you've got Schwab. It's all over the show. So if I'm looking at this, I'm saying, all right, if the financials can rally here, you've suddenly got a focus, and that focus says, within the context of other areas perhaps weakening, you've got the areas that were the weakest before starting to move. That's if you have the dollar pull back and you start to see the commodities at least. My thinking here is that the Fed is not afraid of inflation. They would like to stir up some kind of inflation. So why wouldn't they want to somehow target the dollar just for the moment? And that's my thinking. Could be completely wrong. I'm not an economist. I'm trying to put the plethora, the Rubik's Cube together here of all these different areas. And that's what I think I'm looking at. Financials might rally. Commodities don't have to have a spectacular move. They just need to have a rally. Dollar pulls back a little bit. The euro-dollar currency pair moves up. Canadian USD, Canadian dollar pulls back. What I'm looking at here is the idea that I've been looking at for subscribers, dividend type areas that have started to move very well, because I want capital gain with a dividend stock. I don't want just the dividend. I'm not prepared to get a dividend of 4.5% when the stock goes down 15%. So I'm doing my very best in that area. We've already picked up one today that is a nibble, I called it, in an area that could be helpful. So this is an area that by tomorrow we should be able to have a little bit of clarity, or maybe a lot of clarity, but at least we'll get a picture of the Fed's thinking, the market's response, and within the market's response, what sectors are now looking much better. I had a question with Dan. Basil, you still see T Telephone and Verizon as mediocre plays for the next few months? No, I do not see them as mediocre plays. They have been mediocre plays, but let me just look at the telephone is acting quite well. Verizon, it's at up 34.17 for telephone. It's within a trading. This is what I've been discussing for a while. It's within a trading band. I would prefer to have got it at the lower part of the trading band in the 33s and the 34s, but it looks to me like that's an area that has the potential to move slightly higher with slightly higher highs and slightly higher lows. That's the way I'm looking at it. Verizon, same sort of thing. So yes, I think that there are areas now where I can say for the comfort of dividends, we're looking at some areas that are showing some stability, and we'll know a lot more at 2 o'clock, 2:30, and we'll know a lot more tomorrow. But that's kind of my thinking right now, that we've got a slight change in the weighting of what's working and what's not. We've got a slight change in the weighting, W-A-I-T-I-N-G, and at the same time, there is a chance that we could suddenly see areas that did not work for a long time at least have some kind of participation in market action on the upside for the coming maybe into January. So that's the way I'm looking at it. I'm trying to keep it as simple as possible, and it makes a selection of stocks. Now, on the short side, there are still areas that I think are vulnerable to going down further. Let's just look at that IBB. IBB, a big spike today. It's actually a fantastic move from 315 to 331, 5% rally. But you've got a lot of resistance at the 334 200 period exponential moving average. It's at 331.09 right now, up $1.10. I'm still looking at this as potentially making a hat trick top, taking time and price. Although I do believe that a huge chunk of the down move for now has been accomplished, and now you're just meandering to the side, slightly higher highs, slightly lower lows in the weekly, slightly lower lows and slightly lower highs in the daily. But at the same time, that monthly is suggesting by the technicals that in the longer term, intermediate term to long term, I think that the IBB is going to be going lower. What about the XLV, which we've actually stepped aside with for the last little bit? Trading at 71.81. This is the S&P Healthcare Spider Fund. Yeah, I think this is a problem. I think it's also making a hat trick top here. Well, it certainly has over the past 1, 2, 3, 4, slightly lower lows, slightly lower highs, just fractionally each month since the high at 77.40 in August. The XLV has gone to 73.26 high in September, 73.00 in October, 72.91 in November, and you've got December so far 72.61. I mean, that you can draw a straight line. That is incredible. Just slightly lower highs, but it's saying that there's a lot of resistance in rallies in the XLV. I think the XLV is in the category that says hat trick top, lower lows and lower highs in the monthly. That's the way I'm looking at it. Okay, so let's go back to our story now. I didn't do anything with bonds. Now let's look at bonds. The TLT made a peak E, and now I can call that an E. We'll see what happens by the end of the day if it recycles. I'm calling it an E for now. But the MACD hasn't turned negative. It's turned down, but not negative, and the stochastic has. It's gone to 64%. So I should put a down arrow, but I have to wait till the end of the day before I can do that. It's been repelled by the resistance line in the weekly, but the support line is going to be really important. I'm still thinking, so 119s I've said to subscribers is what we've got to watch at. That's going to be key for support in this symmetric triangle. The weight of the triangle actually is more to the downside because of the length from 138.50 to the high of August at 128.92 and the recent high last week of 124.10 because it's longer. But the angle is just a little deeper than the rising angle. Excuse me. So now this is what I'm looking at. If you look at the monthly chart, it says we could be stuck in a range. Now, if there are going to be higher yields to come, then you would anticipate that the TLT should start to decline. So that takes me to this chart right here. Let me get out of this one right here. Close workspace, save, yes to all. Go to my oops, that was a mistake. Go to my recent workspaces, long-term charts, and we'll go to the yield, the triple yield chart. Okay. Looking at the triple yield chart, not that one, but that one. I'm going to expand a little bit just for the moment and show you that resistance long-term, very long-term horizontal trend line, which is somewhere in the, let's call it a thick line. So let's just call it somewhere in the 31.15 area, 3.15%. The 30-year, the white is 30-year, it's trading at 30.13. That's the TNX. The TYX is this one here, TNX. Oh, wait, well, this one was the TYX. Yeah, the TYX is the 30-year yield. The 10-year T-note yield is a TNX, and that's at 22.98. It only has to go above 23.77, and it starts leg C. And then you've got, wait a minute, I must not in. And then you've got the, oh, look at this, 1774, 1779. And then you get 1779.80. We've made leg B, a peak B, already in the 5-year T-note. Wow, that's interesting. And this is holding way better than any of the others. The 5-year is the one that's really going to be the clue for me. And if the 5-year starts to rally strongly, much stronger in percentage terms than the 10-year, and the 10-year rallies better than the 30-year, we could start to see a yield crossover. We could start to see that the yield, the 5 is getting really close to the 10, and the 10 is starting to catch up to the 30. That essentially hits that whole flattening of the yield curve. This is going to be very interesting as to what happens to the impact that yields have traditionally on the stock market. And that would take about 2-3 weeks, maybe early January before we'll know that. So I'm watching it real closely. So let me just squash this chart a little bit so that you can see exactly what it is. Not a little bit, but a lot. This is the 30-year T-bond yield, right there, the white one. Yellow is the TNX, or yellow gold, and cyan, light blue, is the FVX. This is the 5-year. And you can see what's happening. This is the closest together they've been in a long time. Look at that when they hit the bottom there. And that's why we've got to be monitoring this real carefully. Why? Because if there is a break above the peak D and peak E, the E at 32.55 in the 30-year T-bond yield, it's a breakout. And that says that we're going to go to higher highs and higher lows in the yields, in the 30-year yield. And if it's the 10-year, it has to break above peak D, which was at 24.03. So going to 24.04, but I'd say I'd like a little higher to really get a sense of momentum to the upside. That's going to be very interesting. So, and we could get a real quick C at the moment with the 5-year. I'll be back straight after this break. Basil Chapman, waiting for the Fed. It's getting closer. 2 hours and 10 minutes. I'll be right back.
Until recently, it was almost impossible for the average investor to hedge against currency risk in Europe or Japan. For a bold trade on Europe or Japan that protects against moves in currency, trade HEGE or HEGJ, 2 times currency hedged leveraged ETFs from Direction Investments. Visit directioninvestments.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Hi folks, Basil Chapman here. On Friday, I wrote this down in my notebook right here that I have every day in front of me, and I forgot to look down to see what it said. On Monday, I had it written down again. Said, you've got to mention it because this is what you do. Forgot. Yesterday, I was about to mention, and then I got sidetracked. And that was the perfect time to do it, but I'll mention it today. And what it says is, on Friday, I had, based on methodology that I have, just for myself, I had a daily, I know it's going to sound a little funny, but a daily sell signal, a peak F sell signal, this is just a daily, on Trump. This had nothing to do with politics. This has to do with the social, it has to do with media content, really. That's the only way I look at it. And it had, as I say, it's not a political statement, it's just on the effect that Trump had, and I thought that if I had to count the number of times the word Trump, I'd seen the word Trump. That's kind of one of the ways I do it. It just seemed to me that on the shorter term, it looked like he had made what I call a peak F top, and that his numbers should start to weaken, at least for now, for a while. So I just thought I'd mention that. It has nothing to do with the market. It has nothing to do with anything other than what I like to call my Trends Watch section. So we'll see if that works out. Okay, back to our story. Question of the day is HSIC, Henry Schein Dental Supply. Unbelievable chart. Just a magnificent company. I'd mentioned it a while back as owned. I recognized the owner's accent a long time ago. As South African, and I believe he is a South African that is the CEO of the company. And look at this, made an all-time high this month of 160 round number high. I didn't realize that until right now. So that was a peak F in the daily, a leg D, which is now a peak D in the weekly, but the technicals are still very strong, and a leg D in the monthly. So I'll be watching this one because it might be part of the group that I look at as absolute leaders, which might be saying that we're getting real close to some kind of a consolidation in the very high, not the very high priced, because at 150 you've got much higher price stocks, but in the category of higher multiple stocks and higher price. I don't know what the multiple is. I do know it's kind of high, but I just don't remember exactly. So as far as a sell or short, this is not the kind of stock I would be thinking of shorting because it's still showing tremendous strength, but I would not be buying it at this particular point. I'd be waiting to see how it handles support at 152 or a breakout at 157.5. If it breaks out, it says, okay, just going sideways, taking a breather. But it's been a spectacular stock. And the question was, is it making a peak D? Yes, it's made a peak D in the weekly chart. So that was the answer to that. Okay, let's run this again. The Dow's up 27. That's not the issue. It's the VIX index. As far as I'm concerned, that's going to be for me quite a big clue as to how the market's perceiving what the Fed says. And as I say, they're going to try to make it as benign. I think they're going to try to make it as benign as possible. My guess is that they would also like to hone in. I don't know how they'll do it, but hone in on the dollar. Try to get the dollar a little bit weaker. That's just my thinking, okay? And if that's the case, you will see some kind of a bounce in the commodities. And it's about time that you saw that. That doesn't mean to say that they've changed course, but at least for the short term, this is the opportunity that they can do it. So I wanted to go through that. Today's Wednesday. You're going to have Daryl coming up. Just great program all the way through. For my subscribers, I will give a 2:30 update. Probably won't be doing very much, but at least I'll give an update because we need to see directional. Is there a directional change? What exactly is going to happen in the market? How's the XLF holding it, the financials? How's the VIX? What's happening to bonds? Bonds, I think, obviously, yields are going to go a little higher. How high? Do they pop and then just stay still? That's going to be the big issue. So have a great day. Be back tomorrow, and it's going to be an exciting 24 hours. See you in 24 hours' time, or 23 hours' time. Thanks for being here. Have a great day.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
This is TFNN.